Welcome to ELRA News, where we break down the most pressing global developments. Today, we're diving into a high-stakes economic standoff between Russia, the US, and the EU. Over $280 billion in Western assets within Russia are now at risk as geopolitical tensions escalate. Could this spark an all-out economic war? Stay tuned as we unpack the details. Let's start with how we got here. On December 16, 2024, the European Union introduced its 15th sanctions package against Russia since 2022. These sanctions aim to economically isolate Moscow in response to ongoing tensions over Ukraine. However, Russia is fighting back with bold countermeasures. Moscow has targeted $280 billion worth of Western assets within its borders, including businesses and banks. This includes forcing companies to sell their operations at a 50% discount, alongside a steep 35% exit tax. The West currently holds the upper hand in frozen assets, locking down over $300 billion in Russian central bank reserves and another $58 billion in assets belonging to Russian oligarchs. Meanwhile, Russia's $280 billion target is more decentralized, spread across Western companies operating in various sectors like consumer goods, energy, and finance. While harder to seize, this decentralization also presents unique challenges for Western businesses. Russia's retaliatory actions are creating significant headaches for major Western companies. PepsiCo, facing asset sales at massive discounts and disruptions to its supply chain. ExxonMobil has already exited with billions in stranded investments. Danone, its Russian operations have been nationalized. Unilever, struggling to repatriate profits while selling assets at a loss. These measures aim to financially weaken Western corporations while boosting Russia's domestic economy. Russia's strategy includes several calculated moves. Exit taxes, increased from 15% to 35% to make leaving the market more expensive. Profit restrictions. Western firms cannot repatriate earnings, keeping funds within Russia. Seizures and takeovers. Legalizing asset expropriation to target Western businesses and infrastructure. These measures aren't just about economics. They send a clear geopolitical message that Russia won't back down. The stakes extend far beyond Russia, the US, and the EU. Let's look at the ripple effects. Energy markets. Russia's dominance in oil and gas means potential disruptions for Europe and global supply chains. Foreign investments. Rising fears among international investors could destabilize emerging markets. Diplomatic relations. These tit-for-tat measures are driving deeper geopolitical divides, risking long-term global economic stagnation. The EU isn't sitting idle. As part of its 15th sanctions package, it has introduced protective measures, nullifying Russian court orders, preventing asset seizures or financial penalties enforced through Russian courts. Extended deadlines, allowing companies more time to exit Russia without rushed financial losses. Protection for financial systems, shielding European securities depositories from retaliatory sanctions. These measures are designed to protect European interests, but their long-term effectiveness remains uncertain. With both sides escalating their economic standoff, questions loom. Will these sanctions and countermeasures spiral into a full-scale economic war? Can diplomacy intervene before the global economy suffers irreversible damage? The answers to these questions will shape not only this conflict, but also the future of how nations navigate economic power and global trade. This developing story highlights the fragile balance of global power. For more in-depth analyses of international economic trends, subscribe to ELRA News. If you have thoughts or questions about this story, leave a comment below. Don't forget to like this video and stay tuned for updates on this escalating situation. Thanks for watching.